Something strange is happening in 2026. Companies are laying people off because of AI, and at the exact same time, the stock market keeps hitting record highs. If jobs are disappearing, who is powering the economy? And if the economy is strong, why does it feel so unstable? Today we're breaking down the real reason this contradiction exists and what it means for your financial future. Because this isn't random, it's structural. And once you understand the structure, everything makes sense. The headlines don't match reality every week. We see news like, tech company cuts 10% of staff due to automation. AI replaces customer support. Teams, fewer junior analysts hired this year. At the same time, markets rally, indexes push higher. Investors celebrate earnings beats. That creates confusion. People assume strong markets mean strong job growth, but that assumption is outdated. The stock market is not a jobs report, it's a profit machine, and AI is rewriting how profits are created. What the stock market actually measures, the market does not measure happiness. It does not measure employment stability. It measures expected future earnings. That's it. If investors believe companies will earn more money in the future, stocks go up, even if that future includes fewer workers. And AI has introduced something powerful: profit growth without payroll growth. For decades, companies grew by hiring more people, more sales teams, more analysts, more managers. Now, AI tools can write code, analyze data, generate marketing campaigns, handle support tickets, draft legal documents, create reports, all without salaries. From a corporate perspective, this is efficiency. And efficiency increases margins. Margins increase earnings. Earnings increase stock prices. That's the chain reaction. The productivity explosion economists call this a productivity shock. Productivity means output per worker. If one worker can now produce 2x or 3x more using AI, the company becomes more profitable without expanding staff. This is historically powerful. Previous technology revolutions replaced physical labor, but AI replaces cognitive labor. That's new. It affects writers, designers, junior developers, data analysts, researchers, administrative roles. Entire layers of middle functions are being compressed. And when companies cut those layers, costs fall fast. Wall Street sees that before Main Street feels it. That's why stocks move first. Why markets celebrate layoffs. This is uncomfortable, but important. When a company announces layoffs tied to automation, its stock often rises. Why? Because investors calculate lower payroll, lower long-term liabilities, higher scalability, stronger margins to investors. That's bullish. It doesn't mean layoffs are good for society. It means they are good for projected earnings. The market rewards efficiency, not employment. And AI is the biggest efficiency upgrade in decades. Here's where the real tension begins. AI benefits to groups differently. Group 1. Owners, shareholders, investors, founders, tech infrastructure providers. Group 2. Labor, sellers, employees, freelancers, entry-level professionals. When productivity increases through machines instead of human effort, profits concentrate toward owners. Wages don't automatically rise. That creates a gap. Markets look strong, but many individuals feel pressure. That disconnect is exactly what we're seeing in 2026. Why it feels unstable: you can have rising GDP, rising corporate profits, rising stock prices, and still feel economic anxiety, because growth distribution matters. If fewer people capture more of the gains, the overall economy can expand while personal stability declines. That's not a conspiracy. It's structural math. Automation reduces dependency on large workforces. That shifts bargaining power. And markets price that shift immediately. The historical pattern: every major technological shift created disruption. Industrial revolution displaced manual labor. Computers replaced clerical roles. The internet reshaped retail, but AI moves faster. It scales instantly. It learns continuously. It improves without fatigue. That speed compresses adjustment time, and markets move ahead of social adaptation. That's why stock charts can look optimistic while headlines look chaotic. The investor perspective: investors aren't asking, are jobs safe? They're asking, will earnings scale? If AI allows companies to expand globally with smaller teams, valuation multiples expand. Investors are betting on automation platforms, cloud infrastructure, semiconductor demand data centers, AI integration tools. They're positioning for long-term margin expansion. and markets always move toward where capital expects growth. The personal reality, so what does this mean for individuals? It means job security alone is no longer enough. Adaptability becomes currency. Understanding leverage becomes critical. The old model was, get a degree. Get a job, climb ladder. The emerging model is, develop adaptable skills, understand technology, create leverage, own assets because ownership benefits from productivity expansion. Pure labor exposure doesn't. That doesn't mean jobs disappear. It means the structure changes, and ignoring structural change is expensive. The hidden opportunity, here's the part most fear narratives ignore. AI is not only replacing tasks, it's lowering barriers. One person can now start a business, launch content, automate operations, analyze markets, build digital products at speeds impossible 5 years ago. Technology doesn't eliminate opportunity, it shifts it. Those who adapt early often benefit disproportionately. The key difference is mindset. Compete with AI or leverage AI. So why are stocks hitting record highs while jobs feel uncertain? Because the market rewards efficiency, and AI is the greatest efficiency tool of this generation. This isn't a contradiction, it's a transition. And the people who understand transitions early rarely stay behind. The real risk in 2026 isn't automation. It's standing still while the structure changes. If you found this breakdown valuable, subscribe for more deep analysis on economic shifts shaping the future. Because clarity is leverage, and leverage creates advantage.